Are you considering retiring in the near future? If so, do you believe that your current financial situation will allow you to maintain your standard of living? If the answer is yes, congratulations. Otherwise, I recommend that you keep watching. Before we begin, though, please hit the like button, subscribe, and turn on notifications if you enjoy this kind of content. The forecast for the next 5 years indicates a remarkable opportunity in autonomous driving with the potential to reach trillions of dollars, according to recent Tesla stock news. The company's stock price may skyrocket to an astounding $1,000 per share by 2026, leaving its current value of about $200 far behind. If you were to invest in Tesla shares right now, how much would you be willing to risk on this automotive powerhouse? Even a small piece of this enormous market would have a significant impact on Tesla, positioning them as the front runner. With more groundbreaking innovations on the horizon, Tesla has emerged as a pioneer in the electric vehicle industry. With these lofty objectives, the company not only seeks to produce outstanding products but also works to make them as affordable as possible. In either 2026 or 2027, Tesla appears to be on track to surpass all other automakers in sales. Hello everyone and welcome back to Only Pay. The rapidly expanding EV industry, Tesla has managed to secure a solid market share despite the entry of numerous competitors. Considering Tesla's current valuations and prospects, it may be prudent for investors to upgrade their investment rating from a hold to a more optimistic bond. Let's explore why, unlike some of its competitors who have trouble making a profit, Tesla has maintained its position over the years, and it is likely that their dominance will only increase as the industry develops further. Tesla has established itself as a highly profitable company, making its stock a desirable long-term investment. The very nature of being an automaker has been redefined by Tesla. Beyond promoting electric vehicles, the company has revolutionized sales tactics by eschewing traditional dealerships and choosing a direct-to-consumer strategy. Additionally, Tesla has foregone traditional advertising in favor of gaining media attention and utilizing the power of word-of-mouth marketing. These calculated risks have paid off handsomely and elevated Tesla's premium brand image to new heights. According to industry experts, Tesla consistently creates significant consumer demand while also eliminating costs that legacy automakers take for granted. The average price target for Tesla stock over the next 12 months is around $218.95 per share, but some forecasts soar as high as $430.33. While others only sink to $33.33, let's think about the financial side of things. In North America, the average monthly expense for each person is around $3,000 when you factor in other miscellaneous costs. Travel and medical services, this sum rounds up to about $5,000 per month or $60,000 per year. To live comfortably for the next 33 years, you would need about $2 million. What does this mean for your retirement and the possibility of tests to share while taking Tesla's current valuation into account? It appears likely that this stock could be a wise investment in the upcoming years. For a number of reasons, investors should keep an eye on two potential catalysts that could have a significant impact on Tesla in the near future. In addition to Tesla's profitability at the gross margin level exceeding expectations, there is a strong indication of higher than expected vehicle demand, as demonstrated by the company's impressive delivery numbers. These positive developments are positive for the company's financial outlook in the long term and midterm. While current market expectations for EV penetration in the United States by 2030 range from the mid-40s to the mid-50s percentage points, one of the main reasons for Tesla's optimistic outlook is the potential for a rapid increase in EV penetration. According to a research report by Needham & Companies, automakers might be aiming for much higher numbers. By 2030 or 2035, the majority of automakers intend for 100% of their sales to be made up of electric vehicles. This suggests that analysts may be overly cautious in their projections, leaving room for forthcoming favorable surprises that would benefit Tesla as well as the market in the long run. The company has seen significant revenue growth from its services and other businesses over the years, so future growth at Tesla is not solely dependent on increasing vehicle sales. For instance, there is still plenty of room for expansion. Tesla's supercharging revenue has a lot of potential. According to a Goldman Sachs research report, the incremental revenue opportunity could be between $1 and $3 billion within a few years if Tesla makes its supercharger network available to all EV drivers. Future EPS or bottom line growth for Tesla is anticipated to be rapid, possibly even exceeding revenue growth. Operational leverage and the potential for capital return to shareholders are the primary drivers of this optimistic outlook. Ability of Tesla to gain from successful operational in the third quarter of 2022, leverage becomes apparent. Despite the company's substantial 55.9% revenue increase and a meager 2.3% increase in operating costs, Tesla demonstrated its capacity to increase profits demonstrating how the company's financials benefit from efficient operations. Leverage and share repurchases can both help the company's EPS growth in the future. During Tesla's Q3 2022 earnings call, the company emphasized its ability to repurchase between $5 billion and $10 billion worth of shares, even in the event of a negative outcome. Tesla has been causing a stir in the American market, selling 491,000 vehicles there as a result. Tesla recently overtook BMW, which had held the title of U.S. luxury sales leader for the previous 3 years, but BMW only sold 332,388 vehicles in the country in 2022, demoting them to second place. With a total of 286,764 sales, Mercedes-Benz came in third. Lexus came in second with a total of 258,704 sales in 2022. Looking ahead, Tesla not only outperformed these well-known brands, but also made history by becoming the first American automaker to top the list in 25 years. Tesla's U.S. unit sales are anticipated to rise even further, with projected $20.69 billion revenues in 2023. By 2027, the companies project that the market will have grown by 3.97% annually, reaching a projected market volume of $19 billion. Morgan Stanley analysts believe that the current upward trajectory of Tesla stock represents a favorable entry point. The company previously reduced its price target from $330 to $250 per share to take into account a scenario in which Tesla might find it difficult to meet future demand for EVs, as well as a recent development. Adam Jones, an analyst with Morgan Stanley, reiterated his overweight rating on Tesla's stock. According to Jones, despite the EV market's high level of competition, Tesla has the potential to succeed due to its self-funded players' established scale and efficiency. Tesla-like supply chains stand a good chance of succeeding in the market. Tesla has experienced phenomenal growth, quadrupling in value in just 4 years. If the company keeps growing at this rate, the stock price may reach a startling $1,000 per share by the year 2027. While it may seem unthinkable for Tesla to outgrow such industry giants, Morgan Stanley analysts predicted that Tesla's revenue would exceed $300 billion and surpass that of both Ford and General Motors within 5 years back in 2022. By 2027, according to Morgan Stanley, Tesla's revenue will be greater than that of the two combined. The analysts predict marginal growth shares decline for Tesla competitors, which would be absorbed by Tesla itself. They suggest that Ford's market share may potentially decline from 12.5% to nearly 10% by 2030, and GM's unit share may decrease from 14.6% to under 12%, whereas Tesla's wallet share may increase to 23% by the end of the decade. Morgan Stanley also predicts that Tesla will surpass GM's share of new car sales. Although Morgan Stanley recognizes that Ford and GM can still remain relevant in the EV ecosystem by scaling back and losing money, they caution about potential risks for these conventional automakers, including rising labor and material costs, as well as the execution of scaling back on upcoming EV model launches. Despite the Tesla share's recent underperformance, looking ahead, the long-term outlook is still favorable. According to its projected compound annual growth rate for important financial metrics, Tesla is anticipated to keep expanding rapidly over the following 5 years. While investors may be concerned about market conditions, Tesla's ability to maintain profitable vehicle sales in a difficult economic environment, the general consensus is that Tesla will remain a fast-growing company. The expected compound annual growth rate for its top-line revenue, net profit, and free cash flow further support this idea, so the question is whether Tesla will continue to grow at a rapid pace. A sensible retirement decision. Share your opinions, including your assessment of Tesla, in the comments section below. If you're interested in staying up to date on Tesla news, be sure to click on the next video on your screen.